Okay, so I left you in suspense on our last presentation, but it gave you time to think about it. So based upon the aging of our receivables, 2,228 will be the allowance for doubtful account ending balance. We're saying the account balance already of 528 on the credit side. So the question is, based upon these amounts, what should be the amount of bad debt expense to be recognized for the current accounting period? To get the bad debt expense amount, we're going to subtract the beginning balance from our desired ending balance to get 1,700, and that's the amount we're going to record as bad debt expense for the current accounting period. And recall, to make this journal entry, you would debit bad debt expense and credit the allowance for doubtful account. So to recap, with the aging approach, this 2,228, this is not your bad debt expense amount. This shows the desired ending balance in the allowance for doubtful account. Now, if the account has a balance already, we must figure out the amount of expense to be recognized for the current accounting period. So if the amount was zero, the expense would have been 2,228. But because it was already 528, the amount of expense required only totals $1,700. Okay? So we talked about another company before. Now we have Skechers, and they're giving you notes and information pertaining to their uncollectible account as well. So this information will be found as part of the annual report for the Skechers company. Okay? Let's try an example. We have the Brule company has been in business for 5 years. The unadjusted trial balance at the end of the current year shows account receivable, 30,000 debit balance, sales revenue, 108,000 credit balance, allowance for doubtful account, 2,000 debit balance. Bad debts are estimated to be 10% of receivables. Prepare the issue to adjust the allowance for doubtful account. So the question is, first we want to figure out what should be the allowance for doubtful account ending balance based upon 10% of our receivables, and there says the allowance for doubtful account has a debit balance in the amount of $2,000. Okay, so we're going to debit bad debt expense for $5,000, credit the allowance for doubtful account for $5,000. You're like, what? How'd you get $5,000? I'm glad you asked that question. Well, we're saying 10% of 30,000 is 3,000, right? And the allowance for doubtful account, once we're done, should have a balance of 3,000 shown on the credit side. But notice the beginning balance for the account was 2,000, and that amount is shown on the debit side. I should have drawn you guys a T account, but what that means is that in order to go from a 2,000 debit balance to a 3,000 credit balance, I must credit the allowance account for $5,000 in order to get my desired ending balance allowance account of 3,000 shown on the credit side. So to simplify, if the allowance has a debit balance, you're going to add that to your desired ending balance to get the amount of your bad debt expense. If the allowance has a beginning credit balance, subtract that from your desired ending balance to get the amount of your bad debt expense. All right? We're going to switch gears a little bit. We're still discussing receivables, but what's called factoring of receivables. What does that mean? Pretty much it means that a company is going to sell the receivables to a finance company or a bank. Why would they do that? In order to speed up the collection process. So we need money and we want it now. Okay, no commercials. What we're saying here is that because it may take the client 45 days to pay, 6 days to pay, 9 days to pay, depending on our credit terms, and we're saying we need the money now. So a company will buy a receivable, but they're going to charge us a fee. That fee may range anywhere from 1 to 3% of receivable. It could even be higher because the finance company makes their money by charging you a fee for taking on your receivables. All right? For example, a furniture company factors receivables, which means sales down, receivables amount of $600,000. Federal factor charges a service charge of 2% of the amount sold. All right? So the amount of cash received will be $588,000. That's the $600,000 less the 2% service charge. The service charge recorded as an expense for the $12,000 and will then credit accounts receivable. So again, the amount of cash received is the $588,000. That's the $600,000 less the 2% service charge, was recorded as an expense, and then we'll credit account receivable for the full amount of $600,000. So these receivables now will be collected by the finance company instead of by this furniture company. Okay, so it says to factor our receivable, that means we're going to sell receivables to a finance company. All right, what do we got next? Credit card sales. How do credit card companies make their money? Well, two ways. First, when you use the credit card, they're going to charge you interest, right? So as consumers, we pay interest to the credit card companies. But did you know when a retailer accepts credit card as a form of payment, they too must pay a fee to the credit card company. Typically, the fees range from 2 to 4% depending upon the type of credit card that you're using. So normally, MasterCard and Visa has a lower rate, Discover has a higher rate, and American Express has the highest rate. That's why there are certain places that do not accept the American Express as a form of credit card payment because they have to pay a higher fee to the actual credit card company. Let's see how that works. We got Morgan purchased CDs, compact discs for $1,000 for her restaurant from this music company store. And she charged them on her first Visa bank card. All right. So Visa is going to charge the music company a 3% fee for accepting Visa as a form of payment. It's just a cost of doing business. So to record this transaction, the music store received $970 in cash from the credit card company. They're going to keep 3% as a service charge expense and recognize sales revenue in the amount of $1,000. So when companies accept credit cards, those companies are required to pay a fee to the credit card company. Okay? And so again, they'll debit cash, recognize the expense for $30, credit sales revenue in the amount of $1,000. We're now moving from accounts receivable over to notes receivable. Okay? When you have a note receivable, that means you have a promissory note, which is a written agreement where you promise to pay the amount of money owed, typically plus interest at some point in time in the future. All right? So, if you have a credit card, student loans, car note, a mortgage, you have signed documentation which is known as a promissory note. Typically, when you borrow funds for your student loans, for your mortgage, or for your car note, you agree to pay the amount owed plus interest at some point in time in the future. Now, sometimes when it comes to customers, a client may sign a promissory note to sell their account receivable. What does that mean? So with the account receivable, perhaps that the amount that was due was not paid on time, and they made them sign a promissory note agreeing to pay the amount owed plus some form of interest. They'll do that because a promissory note carries more weight in terms of legality, because now they have a signature from the customer agreeing to pay that amount of money plus interest at some point in time in the future. This is a sample promissory note made to the order of the Wilmot Company, that's the payee. The amount is for $1,000. The 8% is the annual interest rate. This note becomes due in 2 months. Okay? So to the payee, for the person who the money is owed to, it is a note receivable, which is an asset account. For the maker, the person who owes the money, it is a liability known as the notes payable account. Okay? Let's take a look. Oh, so let me ask you a question on this. So if you see a transaction such as this, the 1,000, 2 months due, 8% interest rate, the question asked is how much interest would accrue on this note at the end of that 2-month time period? Keep that in mind. How much interest will accrue on that note at the end of that 2-month time period? Okay? So, keep that in mind. When you have a promissory note, you're going to have certain things. A maturity date, which indicates at what point that note becomes due. In our example, that note becomes due in 2 months. So sometime it could become due on demand. So they could say at any time it's due, on a stated date like we saw previously, or at the end of a stated period of time. So typically, depending upon the type of note, it's going to have some type of term. The term can be expressed in terms of months or in terms of days. So here we have, to get the interest, you take the face value of the note times the annual interest rate times time in terms of 1 year. So let's say a note has a face value of $730. 12% is the annual interest rate, and the note becomes due in 120 days. Now, from an academic standpoint, when we have in terms of days, we take days and divide it by 360, only because it's easy to do the calculation for 360 compared to 365. So in this situation, you take the face value times the rate times 12, so times time, 120 over 360, and this shows the accrued interest on this particular note. All right? You would do the same thing for the 1,000. Now, it's a term of 6 months, so it's going to be 6 over 12 in terms of month. If it is 1 year, it's just 1 over 1, because these interest rates shown here represent the annual interest rate. So it's principal times rate times time. Okay? So let's go back to our note. We have this note for 1,000. The note matures in 2%. I'm sorry, not 2%. It matures in 2 months, and 8% is the annual interest rate. So on May 1st, we would debit notes receivable for the 1,000 and credit account receivable. In this situation, we made them sign a promissory note in order to pay for an outstanding account receivable balance. Now, the question is that I asked you all, how much in interest is owed to the payee when this note matures in 2 months? How much you got? Okay, hold that number. We'll discuss that in the next section of our Chapter 8 lecture. Bye-bye.